Today we would revise money and credit through real life situation. Now let's understand the first case study. Meet Rajiv and Mahesh. Both are small shopkeepers. Both take a loan of 5 lakh. But their future turn out very differently. Let's understand why. Rajiv used the loan to expand his store. His shop became more attractive, customers increased, sales doubled. His EMI was 12,000 rupees. But now he could easily afford it. For him, credit acted as a growth tool. Mahesh used the same loan but for personal expenses. These expenses were important, but unfortunately, they did not generate income. His business income remained at 30,000. His EMI was 12,000. So nearly 40% of his income goes to loan repayment. For him, credit became a curse. So here, the difference was not the loan amount. The difference was how credit was used. Credit is a blessing when it creates income. But in opposite scenario, when it doesn't create income, it becomes a burden. So we can easily say here, credit is a double-edged sword. So now the question comes, should banks monitor how loans are used? We cannot deny responsibility of bank. Banks have a responsibility to assess repayment capacity, verify loan purpose, etc. However, they cannot monitor every rupee spent. Banks should encourage productive loans and conduct proper evaluation before giving any loans. Rajiv and Mahesh both took loan from banks, but in reality, many poor households don't even reach banks. They still borrow from money lenders. Question is, why does this happen? Let's understand. Most poor people still borrow from money lenders. Today, we will solve an important analytical case study that can come in your board exam. Now pause the video and quickly read this case study. Notice the difference in interest rates and the fact that 85% of landless laborers still depend on informal credit. Let's understand the four main reasons. First reason, instant availability of money. Poor families often need money urgently for medical emergencies, crop failure, etc. Now, banks take time to approve loans, but money lenders give money immediately. During emergencies, speed is more important than low interest. Second reason, minimal paperwork. Banks require many documents like identity proof, income proof, land documents, etc. Poor people may not have proper documents, and moneylenders do not ask for paperwork. This makes borrowing easier. Third reason, flexible repayment. Banks usually have fixed monthly installments, but poor people often have irregular income. Moneylenders allow flexible repayment. Borrowers can pay when they earn money. Last reason, local accessibility. Moneylenders live in the same village. They are easily approachable. Banks may be far away from rural areas. For many villagers, traveling to bank is very costly and time consuming. Now pause. Now think about this. If banks are cheaper, why has not the system changed completely? What is still stopping poor people? Can you say that banking system is not designed for poor? What is your thought on this? Please comment. So in the whole discussion, we understood two things. Number one, how credit is used, that matters most. Second, where credit is taken from also matters. If this case study helped you understand the concept clearly, you can support the channel by liking the video. And if you want more such videos, consider subscribing.